Do you remember the last time the world came to a standstill so dramatically that even the financial markets trembled? The COVID-19 pandemic triggered a crisis of historical proportions, and what we witnessed was a devastating collapse in global markets. But what was even more surprising was the impact an invisible virus had on entire economies, forcing central banks to intervene with unprecedented measures. If you want to understand what really happened behind the scenes of this extraordinary phenomenon and how it shaped the future of finance, get ready to uncover how this crash changed the rules of the game. The start of an unprecedented crisis, the COVID-19 pandemic, was a catalyst for one of the most significant crashes in global markets in recent memory. At the start of 2020, as the virus spread alarmingly fast, fear and uncertainty gripped investors. The extraordinary nature of the situation was how quickly confidence in the global economic system crumbled, leading to a historic market collapse. The financial markets, which usually operate with some predictability, began to experience abrupt daily fluctuations. It was like watching a natural phenomenon of destruction, a wave of selling that seemed unstoppable. This created an atmosphere of curiosity, mixed with fear about how deep this collapse would go. Global markets, always sensitive to news and forecasts, began to react violently. Investors worldwide started selling their assets, seeking to protect themselves amid growing uncertainty. The sharp drop in stock values of major companies became commonplace. What was happening wasn't isolated. It revealed how interconnected and influenced the global financial system is by historical and unexpected events. The collective intelligence of the markets, which often gets predictions right, failed to foresee the depth of this crisis, catching even the most influential economists and investors off guard. The situation worsened as constant updates about the rising COVID-19 cases fueled panic in the stock market. By February and March of 2020, when the pandemic was declared a global crisis, panic selling intensified. It wasn't just an economic issue, but a public health one, which made markets even more volatile. What began as a regional concern quickly spread globally in a devastating and innovative way, leading to historic stock market crashes. It was as if nature was reminding the world of its unpredictability, showing that even the most sophisticated systems are vulnerable to its mysteries. A practical example of this impact was the collapse of the S&P 500 index, which fell over 30% within weeks. Influential companies, once considered safe, saw their values plummet. And it wasn't just the stock market. Oil prices were also severely affected, reaching historic lows. This triggered a chain reaction, sending many economic sectors into deep crisis. To those watching from the outside, it was hard to believe that all this was happening because of a microscopic virus. But at the same time, it revealed how fragile and interconnected the global economy had become. As markets tumbled, a growing curiosity emerged. How would governments and central banks react? The response came quickly and massively. For the first time in modern history, central banks from major world economies, such as the Federal Reserve in the United States and the European Central Bank, coordinated an unprecedented response. They rolled out trillion-dollar stimulus packages, slashed interest rates, and took on a direct role in supporting economies in distress. It was an extraordinary yet necessary measure to try to contain the devastating effects of the pandemic and bring some stability to global financial markets. This crisis also sparked an interesting reflection. How would the world adapt to these new times? The accelerated digitalization, remote work, and changes in consumer patterns began to shape a new normal. The nature of business changed drastically, and many wondered if it would ever be possible to return to what it was before. Yet at the same time, there was a growing awareness that the world was living through a historical moment, something that would be studied for years as an example of human resilience and adaptation. And even amid all the instability, it became clear that, after the storm, new opportunities would emerge. The rapid spread of panic in the markets as the impact of COVID-19 became apparent. Panic spread as quickly as the virus itself. Investors, driven largely by speculation and uncertainty, began selling assets at an unprecedented speed. What was extraordinary about this movement was how quickly confidence in the global economic system disintegrated, sending the market into a downward spiral. Stock exchanges worldwide, which typically operate with some predictability, began to experience abrupt daily price swings. It was like watching a natural disaster, with a wave of selling that seemed unstoppable. This created an atmosphere of curiosity mixed with fear, as many wondered where this collapse would end. This atmosphere of uncertainty was exacerbated by the fact that most investors had no idea how long the pandemic would last or what the real economic consequences would be. Without clear information, the market began to operate on speculation, which is the perfect breeding ground for panic. Many remembered similar historical events, such as the 2008 crisis, and started anticipating the worst. The nature of the markets is often influenced by psychological phenomena, and collective fear fueled the crash even further. Interestingly, unlike previous crises, the trigger was not financial, but a virus, something unexpected and beyond the control of traditional economists. During this time, stocks of companies once considered safe began to plummet drastically. Technology companies, transportation, and tourism were the first to feel the impact, with some experiencing declines of up to 40% in just weeks. Curiosity grew about how these companies would survive the storm, and discussions about the economy's recovery dominated financial conversations. There was a stark contrast between businesses with adaptable models and those deeply exposed to the pandemic's effects. Intelligent investors began repositioning themselves, seeking opportunities amid the chaos, while others, driven by panic, sold everything they owned. The ripple effect didn't stop there. In addition to the stock market, other sectors were severely affected. The real estate market, for instance, slowed significantly as consumer confidence dropped and unemployment rose. Demand for commercial real estate plummeted as companies embraced remote work. This was an innovative and transformative moment, as many realized that the way we work and live was changing permanently. The pandemic, aside from being a public health and economic disaster, was also reshaping social and business paradigms. The panic in the markets also led to a series of governmental interventions. Central banks, which previously hesitated to intervene on such a large scale, were forced to adopt extraordinary measures. The Federal Reserve in the United States, for example, cut interest rates to nearly zero and launched large-scale asset purchase programs. These moves were designed to inject liquidity into the markets and restore investor confidence. However, the nature of this unprecedented intervention also sparked debates about its long-term consequences. Would the economy become dependent on these stimulus measures? This became a point of curiosity for many analysts. As the panic, selling gradually subsided, the damage was already done. By March 2020, the market had lost trillions of dollars in value, and recovery seemed distant. However, amid the chaos, some companies began to stand out, particularly those in the technology and online services sectors. Companies like Amazon, Zoom, and Netflix saw significant increases in their stock prices as people increasingly relied on the internet for work, communication, and entertainment. It was curious to see how, while some sectors faced collapse, others thrived in the disaster. The spread of panic in the markets was an extraordinary phenomenon, but also served as a valuable lesson. Fear, when combined with uncertainty, can cause disproportionate reactions, but it also opens doors to unexpected opportunities. History has shown that, in times of crisis, intelligence and long-term vision are the greatest assets an investor can have. Even during one of the most significant crashes in history, there were those who, with courage and planning, managed to navigate the turbulent waters and find success. The historic interventions of central banks faced with the gravity of the crisis. Central banks around the world had to act with speed and intensity never seen before. The Federal Reserve, the European Central Bank, and other major economic players stepped in with extraordinary measures. The market crash was so fast that, without these interventions, the consequences could have been even more devastating. The extraordinary part of these actions was how they seemed to challenge traditional practices. The sharp drop in interest rates, The massive purchase of assets and the injection of trillions in liquidity into the financial system were seen as desperate yet intelligent attempts to stabilize the economy. It showed that, even in the most complicated situations, innovation can emerge from necessity. The Federal Reserve's first major action was to cut interest rates to nearly zero, which in itself was extraordinary. Never before in modern history had such a drastic rate cut been implemented so quickly. Additionally, the Fed announced large-scale asset purchases, including government bonds and even corporate bonds. This strategy, known as quantitative easing, was a clear example of how central banks were willing to do whatever it took to prevent the complete collapse of the financial system. The curiosity surrounding this situation was whether such measures would work in the long term, or were just postponing the inevitable. The European Central Bank, ECB, was also quick to act. With an economy already weakened by years of low inflation and slow growth, the Eurozone faced a unique crisis. To mitigate the pandemic's impact, the ECB launched the Pandemic Emergency Purchase Program, PPP, a massive stimulus package aimed at ensuring European countries could continue to finance their expenses amid the crisis. The nature of this program was innovative and demonstrated the flexibility central banks needed to handle crises that, at their core, transcended economic boundaries. The curiosity here lay in how such an expansive program managed to maintain cohesion among countries with vastly different economic realities. These interventions sparked an interesting debate about the independence of central banks. Some critics argued that by injecting so much money into the system, these institutions were dangerously close to becoming permanent financiers of governments. Others believed it was the only viable solution to avoid a global depression. The phenomenon unfolding was a challenge to traditional economic paradigms, which have always preached fiscal and monetary prudence. However, it was impossible to ignore that, without these extraordinary actions, the crisis could have led to an even deeper and more difficult-to-recover global recession. One of the most curious aspects of these interventions was how they affected risk perception in the market. By lowering interest rates to historic lows and purchasing large quantities of bonds, central banks effectively pushed investors to seek riskier assets. This created a situation where the stock market, which had collapsed in March 2020, began to recover surprisingly quickly. Within months, the S&P 500, which had lost 30% of its value, was back to pre-crisis levels. It was a historic recovery, but it raised questions. Was this growth sustainable, or were we witnessing a bubble inflated by artificial stimulus? Beyond monetary policy, fiscal interventions also played a crucial role in mitigating the economic damage of the pandemic. Governments worldwide launched trillion-dollar stimulus packages, offering direct support to businesses and citizens affected by the crisis. In the United States, the government passed the largest stimulus package in its history, injecting trillions of dollars into the economy to support small businesses, workers, and struggling industries. This phenomenon of massive and coordinated intervention was unprecedented, and questions about the long-term impact of these measures began to surface. How would economies recover, and what would be the final cost of these interventions? Ultimately, the interventions of central banks and governments showed that, in times of crisis, historic measures are necessary. Curiosity about the future of these economies persists, especially regarding how these extraordinary actions will shape the coming years. The extraordinary aspect of this period is that it highlighted humanity's ability to adapt and innovate in the face of colossal challenges. Yet, at the same time, it left us with a question. What will the economic world look like post-pandemic, after interventions of such magnitude? Unprecedented volatility in stock markets. The volatility that gripped stock markets during the 2020 crash was something unseen for decades. It seemed like stock prices were on a roller coaster every day, with swings so abrupt that even the most experienced investors were stunned. The extraordinary nature of the situation was how the daily phenomena of the pandemic, like rising case numbers or new restrictions, instantly influenced market behavior. In some moments, news about vaccine development sent stocks soaring. In others, a new wave of infections would crash the indices again. The curiosity lay in the unpredictability, with a sense that no one really knew what would happen next. This volatility didn't just affect individual stocks. Broad indices like the S&P 500, the Dow Jones, and the Nasdaq recorded daily movements of over 5%, something uncommon in stable times. The fear index, known as the VIX, which measures expected market volatility, reached historic levels. It was as if the markets had become hostage to a cycle of uncertainty, where any new information, whether good or bad, triggered intense reactions. What was interesting was a change in investor behavior, with many becoming more defensive but also speculative, driven by the fear of missing out on major opportunities or avoiding catastrophic losses. The volatility was even more curious when considering how different sectors reacted in opposite ways. Technology companies, which were better positioned to adapt to remote work and the increasing demand for digital solutions, saw their stocks soar. Amazon, for example, nearly doubled in value within a few months, while companies tied to tourism, like airlines and hotels, faced devastating declines. This contrast between winners and losers in the market created an interesting phenomenon of speculation, where investors tried to identify the next companies that would thrive in an increasingly digital world. Furthermore, the nature of volatility in the oil market was another defining feature of this crisis. In April 2020, the price of U.S. oil briefly traded in negative territory for the first time in history. The world was perplexed by this extraordinary phenomenon, which exposed the fragility of the commodities market amid a sudden drop in global demand. The curiosity about how markets would handle this new economic reality fueled intense discussions among experts. After all, it was something no one expected. Excess supply combined with plummeting demand caused a monumental price distortion. Behind all this volatility, artificial intelligence and algorithms played a significant role. Automated trading systems, programmed to sell or buy large volumes of stocks based on rapid market changes, intensified the speed of declines and recoveries. This led many to question whether human nature was being suppressed by machines in financial decision-making. Price movements became so unpredictable that even the most influential analysts struggled to provide consistent forecasts. Volatility had reached an innovative level, where the fusion of technology and financial markets created scenarios that seemed straight out of science fiction. For retail investors, volatility also represented an opportunity. Trading apps like Robinhood saw an exponential increase in new users, many of them drawn by the promise of making quick profits in such a dynamic market. The curiosity and fascination with riding the waves of volatility led thousands of ordinary people to dive into the stock market, buying shares of struggling companies or betting on a rapid recovery. This mass participation of individual investors, driven by a mix of adrenaline and speculation, added an unexpected component to market behavior, something that would be studied for years to come. The unprecedented volatility of 2020 showed how extraordinarily sensitive financial markets can be to unpredictable global events. But at the same time, it highlighted the resilience and adaptability of the economic system. In the end, despite all the turbulence, the markets began to find some equilibrium. However, the lesson for investors is clear. In times of crisis, the only certainty is uncertainty, and learning to navigate these turbulent waters requires emotional intelligence, strategic vision, and, above all, a constant curiosity about the behavior of the global economy. The impact on oil and commodities prices. The crash of 2020 didn't only affect stock markets. The commodities market, especially oil, was severely hit by the crisis caused by the COVID-19 pandemic. The drop in global demand for fuel, driven by travel restrictions and industrial shutdowns, led to an extraordinary phenomenon. Oil prices plummeted into negative territory in April 2020. This historic event shocked many, sparking massive curiosity about what it meant to trade oil at a negative price. Simply put, the cost of storing oil exceeded its sale price, as excess supply and lack of demand caused an unprecedented collapse in prices. The impact was felt worldwide. Oil exporting countries like Saudi Arabia and Russia faced enormous challenges balancing their economies as their revenues plummeted overnight. Futures contracts on oil, a widely used financial instrument, were also heavily impacted, causing panic among investors. The extraordinary aspect of the situation was how such a vital natural resource became, temporarily, a burden for those who owned it. The nature of global oil demand had changed radically in just a few weeks, and the market was unprepared for this turn of events. Other commodities, such as gold and silver, experienced wild fluctuations. However, unlike oil, which crashed, gold, traditionally seen as a safe haven in times of crisis, saw a significant increase in its value. In moments of extreme uncertainty, investors turned to gold as a protective asset, pushing its price to record highs. This highlighted how, in turbulent times, some assets can behave inversely to others, creating a series of opportunities for astute investors. The phenomenon of safe haven assets wasn't new, but the intensity of the rush to gold during the pandemic was impressive. Beyond oil and gold, other commodities like food and industrial metals also faced unexpected fluctuations. The global supply chain was disrupted, affecting everything from agricultural production to car manufacturing. Demand for basic food items surged due to panic buying in various parts of the world, driving up prices for products like rice and wheat. On the other hand, commodities like copper and aluminum, essential for industries that halted during the pandemic, saw their prices plummet. The curiosity here lay in how the pandemic affected the economy in such distinct ways, depending on the sector and commodity in question. As global economies gradually began to recover, the commodities market started to adjust, but the scars remained. The 2020 crisis taught the world how the balance between supply and demand could be abruptly broken. In the case of oil, a coordinated effort between OPEC countries and other producing nations was necessary to reduce supply and stabilize prices. This agreement was a clear example of how, in times of crisis, international cooperation can be essential to avoid even greater economic disasters. The nature of these negotiations was strategic, showing that even amid a health crisis, the geopolitics of oil continued to play an influential role in the global economy. Lastly, the crisis in the commodities market brought several important lessons. It highlighted the importance of diversification for both investors and countries heavily reliant on a single resource. The curiosity about how markets will evolve in the future, particularly with the transition to renewable energy, became one of the main points of debate. After all, if a phenomenon like the pandemic could make oil worth less than nothing, what will happen when dependency on fossil fuels begins to decline with the energy transition? This question became one of the most important for those watching the future of commodities and the global economy. The rise of big tech amid the chaos. While many economic sectors struggled during the 2020 crisis, a specific group of companies saw an extraordinary opportunity for growth: the tech giants. The pandemic radically changed people's behavior, forcing them to rely more on digital solutions for work, communication, and entertainment. The phenomenon of remote work, for example, made tools like Zoom, Microsoft Teams, and Google Meet essential in the daily lives of millions of people worldwide. The curiosity here was how the nature of these companies, with their innovative business models, allowed them to adapt and thrive in such an adverse environment. Companies like Amazon, Apple, Facebook, and Google Alphabet became even more influential during this period. The demand for online services and e-commerce skyrocketed as people avoided physical stores and embraced online shopping. Amazon, in particular, saw its stock price rise dramatically as consumers increasingly depended on its platform for essential goods. It was extraordinary to see how, amid the chaos, big tech companies were able to expand their businesses while other sectors, like traditional retail, faced bankruptcies and massive revenue declines. This contrast sparked growing curiosity about the capacity of these companies to shape the future of the global economy. Another fascinating phenomenon was the rise of digital entertainment platforms like Netflix, YouTube, and the newly launched Disney+. With millions of people stuck at home due to quarantines and social isolation, demand for digital content soared. Netflix, for instance, saw a record increase in subscribers, further solidifying its position as one of the largest entertainment companies in the world. This demonstrated how the nature of entertainment was changing, with digital platforms replacing traditional media. Big tech, which had already revolutionized how we consume media, now stood as the leaders of a new normal. In addition to entertainment, the tech sector was crucial in transforming entire industries. Education, for example, underwent a drastic change, with online classes being conducted on a massive scale. Platforms like Google Classroom and Microsoft Teams became essential tools for schools and universities worldwide. The curiosity here was how education, an area that had historically been slow to adopt technological changes, suddenly became entirely dependent on these solutions. This sparked a new conversation about the role of technology in education and whether these changes would become permanent after the pandemic ended. In the financial sector, big tech also began to leave a more visible mark. Fintech companies like PayPal and Square experienced significant growth as consumers moved to digital payments and avoided using physical cash due to contamination fears. The nature of this growth was innovative, as these companies not only facilitated online transactions, but also expanded their services to include credit, investments, and even cryptocurrencies. This opened up new curiosity about how the future of finance would be shaped by tech companies, which were now directly competing with traditional banks in many areas. Meanwhile, the growing power and presence of these tech giants began to attract criticism and concern. The increase in the influence of big tech during the pandemic led many to question whether these corporations were becoming too large to control. Discussions about monopolies, data privacy, and regulation began to gain traction, particularly with the increasing use of social media platforms and the mass collection of personal information. The curiosity surrounding how governments would address these issues, balancing innovation with protecting citizens' rights, became one of the most intense debates of 2020. Ultimately, the rise of big tech during the 2020 crash showed how technological innovation and intelligence can thrive even in the most challenging times. These companies, already influential, now position themselves as fundamental pillars of the new digital economy. And the remaining curiosity is, how far can they go? Will we see new companies emerge to compete with these giants? Or are we heading toward a future where a few tech companies control vast areas of the global economy? Changes in consumer behavior. The 2020 crisis brought profound changes in consumer behavior, directly impacting how people shop, work, and interact. With social isolation measures and government restrictions imposed to contain the spread of COVID-19, routines were transformed, and the extraordinary became the new normal. The curiosity about how people would adapt to this new reality was a major point of debate among economists and experts. The most obvious phenomenon was the acceleration of digitalization, with consumers massively migrating to e-commerce, streaming platforms, and delivery services. The nature of consumption was changing, and companies had to adjust quickly to meet this new demand. One of the most striking changes was the explosion of online shopping. Platforms like Amazon, Mercado Libre, and Alibaba saw a significant increase in users and transactions. Products that were traditionally purchased in physical stores, such as food, clothing, and electronics, were now being bought online. The phenomenon of fast deliveries also intensified, with consumers demanding convenience and safety when receiving products at home. This not only transformed how people shopped, but also had a direct impact on traditional retail, which faced one of its greatest crises in history. Many physical stores closed their doors, while others rushed to transition to digital to survive. Another significant change was in the consumption of entertainment and media. Time spent at home led to an extraordinary surge in demand for streaming services such as Netflix, Amazon Prime Video, and Disney+. Online gaming platforms and social media also saw usage spikes as people sought ways to connect and entertain themselves during isolation. This phenomenon of accelerated digital consumption showed how technology could meet emotional and psychological needs, creating growing curiosity about what the future of technology holds for entertainment and social interaction. Food consumption habits also changed notably. During the crisis, the home cooking phenomenon gained momentum, driven by restaurant closures and the need to save money. Food delivery services like Uber Eats, DoorDash, and Grubhub saw significant growth, but there was also a notable increase in the search for online recipes and interest in cooking more elaborate dishes at home. People suddenly became more curious about their culinary skills and began dedicating more time to meal preparation. This created a new market for products aimed at this audience, such as meal kits and innovative kitchen utensils. The changes in work patterns were one of the most innovative and significant transformations. The remote work phenomenon, previously restricted to certain companies, became the norm for millions of people worldwide. Technology, financial services, and even the public sector embraced remote work on a large scale, realizing that productivity could be maintained, and in some cases, even increased outside the traditional office environment. The curiosity that followed was about the future of offices. Would remote work remain after the crisis, transforming the nature of offices and professional interactions? The psychological impact of the pandemic also altered how consumers perceive the value of certain products and services. With economic uncertainties and concerns about health, many began prioritizing purchases that ensured safety and well-being, such as hygiene products and health-related items. At the same time, there was a drop in the consumption of superfluous goods as people began to reflect more on their purchasing priorities. This change in mindset sparked curiosity among businesses about how to cater to a consumer who, after the pandemic, would likely be more cautious, selective, and interested in products offering real value and utility. Finally, changes in consumer behavior brought an important reflection on human adaptation in the face of crises. The extraordinary nature of this transformation wasn't just the speed at which it occurred, but also the resilience and creativity people demonstrated in times of uncertainty. The curiosity about what comes next, how new consumption trends will develop from these changes, remains alive, and companies that can anticipate these new demands will be well-positioned to thrive in an uncertain but opportunity-filled future. The role of fintechs and the cryptocurrency boom during the 2020 crisis. Fintechs and cryptocurrencies played an extraordinary role in how people manage their finances. The pandemic accelerated the digitalization of many aspects of life, and the financial sector was no exception. The use of digital payments surged as consumers avoided physical cash for health reasons, and fintechs like PayPal, Nubank, and Square were able to meet this growing demand. What was curious was how these platforms, already innovative by nature, became essential in a world that was rapidly transforming. They allowed individuals and businesses to conduct transactions safely and quickly at a time when physical mobility was severely restricted. The pandemic also brought a shift in how people thought about investments, and cryptocurrencies like Bitcoin took center stage. Amid economic instability and the volatility of traditional currencies, many began to see cryptocurrencies as an intriguing alternative. Bitcoin, which had long sparked curiosity, saw its value skyrocket in 2020 as investors sought a store of value outside the traditional financial system. The phenomenon of cryptocurrencies wasn't just a response to the crisis, but also a signal that the financial world was becoming more decentralized and digital. This shift raised questions about the future of fiat currencies and the role of central banks in a world where digital money is gaining momentum. The extraordinary growth of fintechs also showed how access to credit and banking services could be democratized. Companies like Nubank, Revolut, and Chime, which offer digital banking services without exorbitant fees and with a user-friendly interface, gained millions of new customers during the pandemic. At a time when many people face financial hardship, fintechs offered quick and accessible solutions, such as flexible lines of credit and payment facilities. This innovative financial phenomenon was especially important in regions where access to traditional banking services is limited, showing how financial technology can transform lives and promote financial inclusion on a global scale. Beyond cryptocurrencies, another innovative financial phenomenon that gained momentum during the crisis was the increasing use of blockchain technology to ensure transparency and security in digital transactions. Blockchain, The underlying technology of Bitcoin and other cryptocurrencies began to be applied in other sectors, such as logistics and supply chains, to track products and ensure the authenticity of goods. The curiosity surrounding how blockchain could revolutionize the economy grew as the pandemic exposed the fragility of global supply chains. Many companies began exploring this technology as a solution to challenges related to traceability and security in an increasingly digital world. The crisis also highlighted the importance of fintechs in crowdfunding and microfinance. Platforms like Kickstarter and GoFundMe saw a significant increase in the number of campaigns as small businesses and individuals sought alternatives to finance their projects or simply survive during the pandemic. This financial innovation empowered individuals, allowing them to seek funding directly from their communities or a global audience. The crowdfunding phenomenon, which was already popular in specific niches, became a real alternative to traditional bank financing at a time when credit was harder to obtain. Finally, the cryptocurrency boom and the role of fintechs during the 2020 crash raised many questions about the future of the global financial system. Are we heading toward a fully digital economy where traditional banks will have less relevance? Could cryptocurrencies one day replace conventional money? The curiosity about these issues is great, and what became clear during the crisis is that financial technology is moving in an innovative and irreversible direction. Those who embrace this change have the chance to be part of a more dynamic, inclusive, and decentralized financial future. The impact on the job market and the future of work. The 2020 crisis brought an extraordinary shift in the job market. Social distancing and restrictive measures imposed by governments to contain the pandemic forced companies across all sectors to rethink their operational models. One of the most notable phenomena was the mass adoption of remote work, something that before the pandemic was considered a privilege for a few. Suddenly, millions of people around the world were working from home, and the nature of the workplace changed dramatically. The curiosity that arose was about the sustainability of this model in the long run, and whether, even after the crisis, remote work would become a permanent part of professional life. The adaptation to remote work raised questions about productivity and the balance between personal and professional life. While many workers adjusted well, enjoying the flexibility that working from home offers, others struggled, especially those who had to balance family and work responsibilities in the same space. Additionally, the lack of face-to-face interactions led many to feel isolated, highlighting the emotional challenges of working from home. This phenomenon brought renewed curiosity about the future of traditional offices. Influential companies like Twitter and Facebook announced that remote work could become permanent for their employees, sparking a debate about the future of in-person work. At the same time, the pandemic accelerated automation in various sectors. With companies trying to minimize the risks and costs associated with hiring human labor, many began investing in artificial intelligence and process automation. In the industrial sector, for example, robots replaced workers in several functions, and even service sectors, such as customer support, began adopting chatbots and automated systems. This extraordinary phenomenon raises questions about the future of employment in a world increasingly driven by automation. Will workers be replaced by machines on a large scale? Curiosity about the professions of the future became central to discussions about the impact of the crisis on the job market. Another important aspect was the rise of the gig and freelance economy as a solution for many who lost their jobs during the pandemic. Platforms like Uber, Fiverr, and Upwork saw a significant increase in the number of workers seeking temporary or project-based work. The flexible nature of this economy allowed people to adapt to the new economic reality, but it also raised concerns about the precariousness of these jobs and the lack of traditional benefits, such as health insurance and retirement. The growth phenomenon of this alternative economy highlighted the need to rethink labor protections in a world where permanent employment may become increasingly rare. Additionally, the impact of the pandemic on sectors such as tourism, aviation, and events was devastating. Millions of workers in these sectors lost their jobs or had their contracts suspended. Hotels, airlines, restaurants, and entertainment companies were some of the hardest hit, and many workers are still struggling to find viable alternatives. However, other sectors like technology, logistics, and healthcare began to demand more workers, especially for roles related to delivery, e-commerce, and medical care. This contrast sparked curiosity about how worker skills need to evolve to align with the demands of a rapidly transforming market. The phenomenon of reskilling and upskilling also gained prominence during the crisis. As many workers realized their skills were becoming obsolete, there was a rush for online courses and training to acquire new competencies, particularly in technology and data analysis. Platforms like Coursera, Udemy, and LinkedIn Learning saw an exponential increase in enrollment as people sought ways to reinvent themselves professionally. Curiosity about the future of work also fueled this pursuit of new knowledge, with the perception that the professions of the future would require more specialized and digital skills. The 2020 crisis forever altered the job market. Curiosity about what the future of employment will look like, where automation, remote work, and the gig economy coexist, will continue to be a topic of great interest in the coming years. While some see these changes as threats, others view them as extraordinary opportunities for innovation and personal growth. At the heart of this transformation is adaptation. Those who can keep up with the evolution of market demands and trends will be ready to thrive in a future that is increasingly unpredictable. The emergence of new investment opportunities amid the chaos of the 2020 crisis. New investment opportunities began to emerge, often in areas few expected. The market volatility, which initially triggered panic among investors, ended up opening doors for those who could identify innovative trends. One of the most curious phenomena was the increased interest in sectors related to technology, healthcare, and sustainability. Companies involved in vaccine development, hygiene products, and medical equipment saw their stocks soar, while tech startups emerged with solutions for remote work and business digitalization. This scenario reinforced the idea that, even in times of crisis, the intelligence of knowing where to invest can generate extraordinary returns. The technology sector, already one of the most influential before the pandemic, became one of the biggest beneficiaries of this movement. Investors realized that companies facilitating the transition to the digital world, such as video conferencing platforms, e-commerce, and cloud computing, were not only weathering the crisis but thriving. Curiosity grew about how these companies would continue to expand after the pandemic, and many began to see them as the future of global business. The phenomenon of digital transformation opened opportunities for investors who were attentive to changing consumer behavior and the growing role of technology in the economy. Another sector that caught investors' attention was renewable energy. With the crisis, many countries began to rethink their energy policies, and the demand for sustainable solutions increased significantly. Investments in solar, wind, and electric vehicle companies began to gain popularity, driven by both the need for economic diversification and government incentives. Tesla, for instance, became one of the most valuable companies in the world during this period, with investors curious about how the transition to clean energy would shape the future of transportation. The ESG, environmental, social, and governance phenomenon also gained traction, with investors seeking companies committed to sustainable and responsible practices. Fintechs, which were already on the rise before the crisis, became another focus of investment opportunities. With the increasing demand for digital payments and growing distrust in traditional banking systems, fintechs continued to attract venture capital. Companies like Stripe and Square saw their valuations rise rapidly as more consumers and small businesses adopted digital financial services. Additionally, the cryptocurrency boom, led by Bitcoin, sparked a new wave of investors curious to explore this decentralized world. The nature of this market, which challenged conventional financial models, created both opportunities and uncertainties. The pandemic also spurred a new wave of investments in the biotechnology and healthcare sectors. Companies racing to develop a COVID-19 vaccine, such as Pfizer, Moderna, and BioNTech, saw a massive influx of capital as investors bet on a quick solution to the crisis. Additionally, startups focused on health technologies, such as telemedicine and remote diagnostics, began to emerge with force. The curiosity, surrounding how biotechnology would continue to evolve after the pandemic became one of the major topics of debate among investors. The crisis's impact accelerated innovation in this sector, creating extraordinary opportunities for those willing to invest in long-term solutions. Finally, another interesting phenomenon was the resurgence of interest in the real estate market, particularly outside major urban centers. With remote work becoming a permanent trend for many companies, demand for properties in suburban and rural areas increased, creating new opportunities for real estate investors. People who previously depended on being close to their offices could now move to more distant regions where the cost of living was lower and the quality of life often better. This phenomenon sparked curiosity about how the real estate market would transform with a possible decentralization of major cities and a new dynamic of supply and demand. The investment opportunities that emerged in 2020 showed that, even amid a historic crisis, innovation and strategic intelligence can open doors to financial success. The curious part is that many of the sectors that prospered were once considered risky bets before the pandemic. But the nature of the market is like this: unpredictable, extraordinary, and full of surprises for those who know where to look. As the world begins to recover, the lessons learned in 2020 will continue to guide investors in their future decisions, always in search of the next big opportunity. Now that you've learned how the market crash of 2020 unfolded, what are you going to do with this knowledge? The world of finance is ever-changing, and this crisis proved that adaptability and intelligence are key to navigating uncertain times. Are you ready to take control of your financial future? Let these lessons inspire you to rethink your strategies and explore new opportunities. Don't forget to subscribe to the channel and activate notifications to keep learning more about the extraordinary world of finance.